Okay, let's dive right into this explainer and uncover the financial mystery behind one of the market's quietest but honestly most explosive compounding machines. We're looking at the Ensign Group, trading under the ticker ENSG. In the financial world, we hear so much noise. It's always about flashy tech startups, AI fads, or overnight meme sensations that totally dominate the headlines. But today, we're going to tune all that out. We're relying strictly on the hard data to examine a business that has quietly built an absolute empire, generating the kind of generational wealth that most investors literally only dream of. The legendary physicist Albert Einstein famously called compound interest the eighth wonder of the world, saying that those who understand it earn it. Well, today we are going to break down exactly how Ensign Group's underlying financial engine works, how they manage their cash, and most importantly, whether the market is currently undervaluing their future potential. Now, what's really interesting about this slide is the sheer scale. This staggering 5,645% return is Ensign Group's 20-year stock performance. Let that sink in for a second. To really ground this concept, just think about what this means for a real-world retirement portfolio. Say you had invested a relatively modest $10,000 into this business 2 decades ago. That single investment would have multiplied more than 56 times over. It would have transformed into over $564,000 today. No way, right? But it's true. This isn't a typo, and it isn't the result of a sudden speculative bubble or a meme stock frenzy. No, it's the mathematical reality of a compounding machine operating at absolute peak efficiency over a very long horizon. Section 1, the 5,600% return, tracing the historic climb. We are going to put on our financial detective hats and work backward through the data to figure out exactly how this historic climb happened. And more importantly, if the trend will continue. Looking at this timeline, we can see this isn't a flash-in-the-pan event. With an 800% return over 10 years and a 2,500% return over 15, this is a consistent, long-term wealth compounder. You see this a lot in the market. A stock spikes at 1,000% in a single year, purely on hype, only to crash right back down to reality. But mapping out Ensign's timeline tells a completely different story. The magic here is the velocity of compounding as time goes on. Their total return compound annual growth rate, or CAGR, over the last 20 years sits at an incredibly rare 24.6%. To put that into perspective, the legendary Warren Buffett has averaged an annual return over around 20% over his career. So Ensign Group beating that benchmark over a 2-decade span, that tells us their growth strategy is highly effective, remarkably repeatable, and robust enough to survive multiple economic cycles, recessions, and global crises. Moving to Section 2, growth, revenue, and cash. Let's move to the actual business operations and see how the underlying engine of revenue and cash is fueling these massive stock price gains. And this brilliantly illustrates their incredibly steady double-digit revenue growth, showing a top-line expansion that recently crossed the impressive $5 billion mark. Think about it. When a newly minted startup grows its revenue by 18%, it's pretty easy, right? The numbers are small. But maintaining that kind of growth at a multi-billion-dollar scale, that's like accelerating a massive freight train. It requires incredible operational excellence. They boast a 5-year compounded annual growth rate of over 16%, which is actually accelerated to nearly 19% over the last 3 years. For a company bringing in over $5 billion to still be growing revenues at this pace is just phenomenal. It tells us that customer demand for their core healthcare and post-acute care services is entirely robust, and rather than plateauing as they get larger, their market capture is actually gaining serious momentum. Before we look at the next clue, let's define free cash flow, because it's the absolute lifeblood of a compounding machine like this. You can think of free cash flow kind of like your personal paycheck. Your gross salary might look fantastic on paper, and that's like a company's total revenue. But free cash flow, that's the actual hard cash left over in your bank account after the rent, groceries, and bills are paid. For a business, it's what remains after they pay for everything needed to keep the lights on and maintain their properties. It's the highly deployable cash they can actually use to buy back stock, pay dividends, wipe out debt, or aggressively acquire new businesses. Frankly, it is the truest, most unmanipulated measure of financial profitability. Just look at this visual. The recent explosion in cash generation is monumental, with a trailing 12-month growth rate of over 211%. This is where the financial story gets extremely exciting. While their 5-year free cash flow growth rate was a modest 4.45%, their 3-year rate jumps to over 54%. And over the trailing 12 months, that 211% growth translates to bringing in more than $370 million in pure free cash. This is a vital fundamental shift. It tells us that not only is the total revenue growing, but the business is becoming exponentially more efficient at turning that revenue into actual deployable cash. When a mature $5 billion company suddenly triples its cash generation efficiency, it acts as rocket fuel for future investments and compounding loops. All right, Section 3, financial health and margins. But massive growth can sometimes mean dangerous leverage, so let's shift our focus to their financial health and examine their vital signs. So the crucial point is this microscopic debt-to-equity ratio of 0.06, which tells us they are achieving this massive growth with an incredibly conservative, safe balance sheet. You see, companies often borrow heavily from banks to fuel rapid expansion, which basically puts the business on a financial tightrope. But a ratio of 0.06 means that for every dollar of equity the company holds, they only have 6 cents of debt. In a high-interest rate environment, heavily indebted competitors are getting absolutely crushed by interest payments. Their margins just shrink as borrowing costs soar. Ensign Group, on the other hand, is practically debt-free. Rising interest rates barely leave a scratch on their balance sheet. Actually, this lack of debt becomes an aggressive weapon, allowing them to hunt for acquisitions and expand market share while their competitors are forced into hiding just to survive. We also see a fascinating capital allocation strategy here. While the 0.14% yield is tiny, their 18 consecutive yearly increases prove they prioritize aggressively retaining earnings for growth over high payouts. Sure, a tiny yield like that might make most traditional income investors roll their eyes and scroll right past, but the real story is that they are still rewarding long-term shareholders with a reliable, growing dividend check. With a payout ratio of just over 4%, they're taking almost all of that massive $370 million in free cash flow and reinvesting it straight back into the business. And let's be honest, when management is historically proving they can generate a 24% annualized return on that capital, as an investor, you absolutely want them keeping the cash to compound it, rather than paying it out to you to be taxed. Moving to Section 4. Is the stock expensive? The big question you are probably asking yourself right now is, given these massive returns and cash flow, how expensive is it to buy the stock today? Let's weigh the premium. As we lay out these ratios, it's clear this stock is currently trading at a premium across the board compared to its 3-year historical averages. Let's quickly define these so we're all on the same page. The price to earnings, or PE ratio, tells us how much the market is charging for a single dollar of the company's profits. Price to sales, or PS, is what we pay for a dollar of their revenue, and price to book, or PB, is the cost for a dollar of their underlying net assets. Right now, a PE ratio of 32.52 is almost 10% higher than its recent norm. The price to sales is up 13%, and the price to book is up nearly 7%. So on paper, a superficial glance might lead an investor to say, wow, this is simply too expensive. I've completely missed the boat. But in the world of investing, a high PE ratio of 32 might be completely justified when a company has a near-zero debt profile and free cash flow growing by over 200%. There's an old, deeply true adage, price is what you pay, value is what you get. Just like a high-performance Ferrari costs fundamentally more than a reliable daily commuter car, a company with this kind of financial profile warrants a higher entry ticket. The broader market is happily paying a premium for Ensign Group right now because absolute certainty, extreme balance sheet safety, and predictable compounding growth are highly sought-after, incredibly rare assets in any economic climate. And that brings us to Section 5, the fair value verdict. Let's piece all these clues together and transition to the final part of our detective work, finding the actual intrinsic value of Ensign Group. To do this properly, we need to understand the margin of safety, which is the cushion we get when we buy a stock for less than its true calculated worth. Ben Graham, the legendary father of value investing and mentor to Warren Buffett, considered this the single most important secret to investing. Think of it like building a bridge. An engineer might calculate that a bridge needs to hold 10,000 pounds of traffic. But just to be safe, they design it to hold 30,000 pounds. That extra 20,000 pounds of capacity, that's your margin of safety. In stocks, because no valuation model is perfectly predictable, having a wide margin of safety protects our capital if the business hits an unexpected speed bump. And the ultimate reveal is the fair value price based on their free cash flow, sitting at a massive $286.23 per share. This calculation isn't just guessing, and it's definitely not relying on market sentiment. It's an objective model. It takes that rapidly growing free cash flow we examined earlier, projects it out into the future based on conservative growth estimates, and then discounts it back to determine exactly what those future cash flows are worth in today's dollars. When we compare that $286 fair value to the recent closing price, around $189, we uncover an incredible 33.64% margin of safety. This highlights a really stark contrast between market perception and fundamental reality. It means that despite the stock trading at historically high-priced earnings multiples, the actual underlying cash generation of the business is growing so incredibly fast that the current stock price is arguably heavily discounted. The broader market simply hasn't fully priced in the reality of their 200+% free cash flow acceleration. So after unraveling this 20-year, 5,600% compounding mystery, examining the zero-debt balance sheet, and analyzing cash flow efficiency that outpaces almost every competitor in their space, the final question you have to ask yourself is a 33% discount enough to start building your position? Take these numbers, look at your own portfolio, and decide for yourself.